Chapter 16 fits very nicely with Chapters 3 and 4, since accounting data is the main source for the computations in Chapter 16. In this chapter, we'll cover forecasted financial statements, the AFN equation, additional funds needed, reviewing financial statements for improvements, how does excess capacity affect AFN, and the general factors affecting AFN. To cover the material in this chapter, we'll use the end-of-chapter mini-case. New World Chemical is a California producer of specialty chemicals. They are currently operating at full capacity and are projecting a 25% increase in sales for 2020. We'll assume all their key ratios will remain unchanged. This slide presents the asset side of New World Chemical's balance sheet, 2019 actual, 2020 estimated. Here's the liabilities and equity side of the balance sheet. And finally, here's their income statement, showing the 25% projected increase in sales for 2020. From those statements, this recaps several key financial ratios for New World Chemical for 2019, 2020 estimated, and industry averages. As you can see, New World Chemical is not in very good shape if these ratios are any indication. Before looking at the AFN equation, we need to review the basic assumptions for New World Chemical. The firm is operating at full capacity. This means all assets grow proportionally with sales, but only accounts payable and accruals grow proportionally with sales. Notes payable is not an operating liability, so it does not grow with sales. The 2019 profit margin of 3.15% and the dividend payout ratio of 30% will be maintained. Sales are expected to increase by 25% or $500 million. The question is, how much outside funding, AFN, will New World Chemical need to support this growth in sales? So here's the basic AFN equation. Let's look at the three components. The first component calculates the total required assets, dollars, to support the projected growth in sales. The second component finds how much will be spontaneously generated through the growth in accounts payable and accruals, sources of cash. The final component finds the amount generated from the retained profit on the increased sales. So AFN is the total required minus spontaneously generated funds minus funds generated through profit. This details each variable in the AFN equation. A asterisk is the assets tied directly to sales. For New World Chemical, this is all assets, since they're operating at full capacity. S sub 0 is last year's sales, which was given. S sub 1 is next year's projected sales, last year's sales times 1.25. Delta S is the increase in sales in dollars. It's S sub 1 minus S sub 0. If sales increases by 25%, then the change in sales, delta S, is 0.25 times S sub 0. L asterisk is liabilities that spontaneously increase with sales, only accounts payable and accruals. Be careful. Sales growth is typically given as a percentage, but in the AFN formula it must be a dollar amount. Spontaneous liabilities includes only accounts payable and accruals, not notes payable. A asterisk divided by S sub 0 is the assets required to support sales. It's called the capital intensity ratio. It's the dollars required to support every new dollar of sales. The higher the capital intensity ratio, the higher the AFN. L asterisk divided by S sub 0 is the spontaneous liabilities ratio. M is the profit margin, net income divided by sales. RR is the retention ratio, the percent of net income not paid out as a dividend. RR is 1 minus the payout ratio. Frequently, the payout ratio is given, not the retention ratio, so be careful. Putting together these numbers for New World Chemical, the change in sales, $500 million. Capital intensity ratio is 0.50, meaning New World Chemical needs to add 50 cents in assets for every dollar of new sales. Spontaneous liability ratio, 0.05. Profit margin was given, 3.15%. The given payout ratio of 30% translates to a 70% retention ratio. With these values, we have everything we need to find the AFN for New World Chemical. Plugging those values into the equation, we find that New World Chemical needs about $170 million in outside funds to support a 25% increase in sales. Note the outside part. Spontaneous liabilities and retained earnings covers what can be internally generated. What's left has to be funded outside. After reviewing the firm's ratios, management believes some changes can be made. They believe they can improve their DSO, days sales outstanding, from its current level of 43.8 days down to 34 days without affecting sales. This would move them closer to the industry average of 32 days. They're building a new facility which will increase net fixed assets to $700 million. They also believe a new inventory control system will increase inventory turnover to 10 times, again without affecting sales. This would be a significant increase from their current turnover of 8.33 times, but still below the industry average of 11. The changes management's anticipating will result in adjustments to the asset side of the balance sheet. It'll have no effect on the liabilities and equity side, nor to the income statement. So here's the asset side of the balance sheet resulting from the expected changes. Note the shift from accounts receivable to cash generated by the reduced DSO and the $700 million in net fixed assets. Looking at the key ratios again, now we see 4 ratios are showing as okay. DSO and inventory turnover are now very close to the industry average, and they're both definitely much better. Total asset turnover is now also okay. The payout ratio, which the firm chooses, is still okay. Now let's look at the components of free cash flow for New World Chemical. For 2019, net operating working capital is current assets minus current liabilities excluding notes payable, $400. Net fixed assets straight from the balance sheet, $500. So capital is net operating working capital plus net fixed assets, $900 million. Using the originally forecasted 2020 values and calculating the same values, net operating working capital is $500 million. Net fixed assets, $625, so the capital for 2020, $1125. Net investment, 2020 minus 2019, $1125 minus $900, $225. Free cash flow, as you'll recall from earlier chapters, is EBIT times 1 minus the tax rate minus the net investment in capital. As you can see here, it's minus 131.25. Recall, a negative free cash flow is not necessarily a bad sign when a firm is in an expansion mode, which New World is for 2020. We assumed that New World Chemical was operating at full capacity, which is almost never true for any firm. If a firm has excess capacity, then that'll reduce AFN. Suppose New World Chemical was operating at 85% of capacity. Then theoretically, they could increase sales to $2.353 billion without adding any new assets. Since the $2.5 billion forecasted for 2020 exceeds this, AFN will still be needed, but not as much. New World Chemical will only need assets to support sales between $2,500 and $2,353. With excess capacity, sales wouldn't change, but with lower assets, turnovers would improve. Less outside funds, less debt, lower interest, higher profit. Several ratios would improve as well. Finally, looking at how AFN is affected by certain changes. Higher dividend payout, less retained funds. Less retained funds lowers the third component in the AFN equation, which increases AFN. Higher profit margin equals larger third component, lower AFN. Higher capital intensity ratio equals larger total funds required, higher AFN. Paying suppliers later, larger accounts payable, larger second component, lower AFN. This ends Chapter 16.